Risks and rewards of investing. That is what we're talking about today. What's up, everybody? Chris Lee, Everyday Finance 101, coming to you with a longer video today on multiple things, actually. One of them being the different risks that investments bring, another one being a little bit of market timing, and we're also going to talk about some expense ratios of funds and how that can impact your portfolio and your return overall. Hopefully it's helpful. That's the goal. Let's get into it. I have another little Google Sheet for you. I love my Google Sheets. And today we are going to research two different funds with different risk levels and kind of see what returns that brings us along with some other things. So for today, the two funds that I have chosen have the ticker symbols FSKAX and FOCPX. These are Fidelity funds. I just use Fidelity as a platform overall. You could really pick the same Vanguard funds or whatever similar platform you use for as far as the brokerage firm goes. But those are the two that we're working with today. And then I have some different categories here that we are going to look at and kind of hopefully get you to understand the risk side of things on the investment spectrum that we got. All right. So first thing that we do is we are going to go to Fidelity, and in Fidelity you don't have to be logged in. I'm not even logged in here. You can see that it gives me the option to log in, so this is just the free stuff that you get. When you search a mutual fund in this top area here, there's a bunch of different data that comes up about it that Fidelity gives us, and so that's what we're going to be looking at today and putting in that sheet. First thing that I wanted to look at was something called a risk rating. And so over here, what Fidelity does, or what Morningstar, I should say, does, is they kind of give you like a snapshot, which they're an independent third party, and they say, hey, this is what we think of this fund. And so they actually have this little risk category here. And when you hover over it with a your mouse, it gives you a number out of 10. I can't like circle it, unfortunately, because it just like hovers over. But this is a 6 out of 10 as far as the risk goes for the fund. So back here, I am going to put a 6 in a risk rating for this fund. Now, the reason, first of all, let's back up a little second here. This fund is a total market index fund, specifically in the USA. So pretty much what this fund is trying to do is buy the entire USA stock market that's publicly traded for the most part, okay? So pretty diverse fund, but the reason that it's a 6 out of 10 is they are comparing it to bond funds, right? Fixed income or even cash. And then also they're comparing it to if you held internationally or other diverse, even more diverse funds than this. And so that's where we kind of land just above the middle with a 6 out of 10. But you got to understand what it's comparing to. So I just want to make sure that you were getting that point as well. Okay. So that is that first one that we got. The next one that I want to get into is the number of companies inside this fund. Now, I told you that this tries to simulate the entire US stock market. So you start usually on the summary tab. I'm just kind of showing you back and forth. If you go to this composition tab right here that Fidelity offers, when you do that, you're going to see how many things are actually inside of this fund. And so right here, you can see that there are 3,816 holdings within the fund. So you buy this one index fund, and it holds 3,816 different companies, okay? The top are going to be companies that you know. They're the big dogs in the USA. But overall, 3,816 companies. So we're going to go back here, and we're going to put 3816. Now, that matters because if you hold a fund with 100 companies versus 4,000, that's a big difference as far as risk goes. But there's some more things to consider. In this fund, even though there is 3,816 companies, they could technically just have all the money in like the top 10 companies. So even though they own 3,816, the top 10 percentage is a pretty important number to look at because you want to see how heavily weighted the top 10 of this fund are. So if we go back here, it actually tells us that. And I'm going to circle it for you. The top 10 holdings are 31.43% of the fund, which is pretty crazy because just take away 10 out of 4,000 companies and there's only 70% of the portfolio left. So that's pretty crazy as far as when you think about it just numbers wise, but some of these big companies, they're so much bigger than other ones in the US that they just dominate as far as the market cap goes. So 31.43. Okay, so the top 10 companies own 31.43% inside of this fund. Now we're going to look at the returns of this fund. So if we go back to Fidelity and you go up here to performance and risk, or you can see it in the top here. For the last 10 years as of May 31st, so we're at the end of June here, but we don't have that data out yet. So for the last 10 years, this fund has performed at a 12.15% clip per year over the last 10 years. US has dominated the last, I would say, 2 decades. So those are above average returns for the US stock market, but is what it is. We're just working with the data. So 12.15. So now we're going to go back here and we're going to put 12.15. Now this next one's going to lead into a couple of my points that I had for this video. Every fund that you invest in has an expense ratio. That's because if it's a robot managing it or if it's a person, someone needs to get paid in the process, even if it's a very small amount, which this one is a very small amount. But we want to be aware of that because in the overall returns that Fidelity shows, they do not include the expense ratio taken out. So we need to do that to get an accurate picture of the true return of this fund. So if we go back here and we go to, you can do this 2 ways. If we go to fees and distributions, it will show up right here, the expense ratio. It also shows up on the summary tab, but we'll just do this one. So this fund, okay, costs 0.015%. That is dirt cheap. That's why I picked this one. You'll see the difference in the second one that we go through. But it's something that you need to know and put down. So 0.015. So over here, expense ratio, 0.015. So then the last kind of column I had here is I am just going to do a formula. I'm going to take the 10-year return. I'm going to subtract off the expense ratio. And so technically, right, instead of us getting a 12.15 return, I think my Excel is freaking out here. We do not want to autofill that. We're going to go back to our pen. Instead of getting a 12.15% return, we actually get a 12.145 if I would have another decimal because of the expense ratio. Okay, so overall, very good fund. This is the total U.S. stock market. U.S. has dominated for the last 2 decades. Will it continue to dominate? I don't know. We'll see. I can't predict the future, which is my third point that we'll get here towards the end of the video. All right, so that is that one done. As far as the risk goes, right, it's a 6 out of 10. So it's not the safest thing in the world. It's not the riskiest thing in the world. It's just above average, okay? So now we're going to go with what I know is a tech-heavier fund, and it's managed by a person instead of a robot like the last one. So FOCPX, okay? So when we go and we have to search this in Fidelity, so I'm going to go back to Fidelity, and in the top here, I'm going to put in FOCPX, and I'm going to click it, and Fidelity is going to show us the exact same data with it. So now that it's loading, we can see a couple of things here. The first thing that I want to look at is the risk. And would you look at that? The risk of this one is also a 6 out of 10. Okay, so we are the same risk, but we're going to look one step further at that. Okay, we're going to go here, and we want to see what is in this fund. So when we go to the composition, you are going to see that this fund only has 150, I say only in air quotes, 158 companies. That's by no means bad, but I just, different than the last one. So 158 is what this one has. So now we go here, and now we have our first moment. I got 2 funds with the same risk rating, but they have 3,600 companies as a difference there. So this is where, as an investor, you have to understand what you're investing in. And so knowing that between these 2 funds, one of them gives me exposure to 3,800 companies, one only to 150. Does that matter? Depends on your risk level and what your investment strategy is. Okay, to me, it does matter, yes. The other thing that matters, the top 10 percentage. If we go back here, you're going to see that the top 10 in this portfolio make up 63.64% of the entire portfolio. So we go back here, 63.64. Why does that matter? You have a heavier concentration, double, in the top 10 than you did with the first fund. So again, we have the same risk rating, but you're telling me one of them has 3,600 more companies and one of them has half as much held in the top 10. That's not adding up to me necessarily. That's why we do more research data-wise, okay? Again, what are you comfortable with, right? Do you love those companies in the top 10 and want them to be 64% tilted? Okay, what's your reward for that? So now we go to the performance and risk tab and we go look at the past 10-year return. Here is your reward. Instead of getting a 12% return, because you took more risk, you got a 16.3% reward per year. So now we go back here, and the 10-year return is 16.3. It's a big difference there, big difference. 4%, you're going to see in a second here how much of a difference it is actually kind of crazy overall. But this fund has a higher expense ratio that we're going to see here in 2 seconds. When I go back here and when I go to fees and distributions, this fund has a 0.73 expense ratio, which is, if we did the math there, it's probably like 70 times more expensive-ish than the other fund. So it's a lot more expensive. It's still decently cheap, but it's definitely more expensive than what other funds we have in 2025. So 0.73. So I go back here, I put 0.73 in, I have that same formula, and so the return, now you're going to notice here, right, the first time we went from 12.15 to 12.14, like no big deal. Now we go from 16.3 to 15.6-ish. That's a big difference, right? Now, again, still, your overall difference here is still way more in favor of FOCPX. Even though the risk ratings are the same, there is way more risk just in the sheer amount of companies you own and the top 10 percentage tilt. But that is what that risk gets you. This risk right here, okay, not here because Morningstar didn't, necessarily make it more risky here. But this risk gets you that bigger return, okay? You have to decide, is that the risk that I want? Some people want one stock. So instead of 158, they would do one stock. And then that's way more risk with hopefully way more return, but depends on who you are, okay? So this kind of, I hope, gives you an understanding as far as the different risk levels that can occur with different investments that you choose. In my perspective, I am more of a safe investor. Okay, I'm not the most conservative. I don't even have any fixed income right now. I'm 28 years old. We are all equities. So I'm way risky in that stance. But I do not actively invest in this fund. I used to. I still have money in it, but not actively. And so I would pick a fund more like this total stock market index fund. Okay, so that's me. You got to decide you. Now, I do want to show you the difference as far as like the sheer numbers go here, because risk, reward. So let's go to a compound interest calculator. I'm going to get out of Fidelity, and we're going to go to a compound interest calculator, okay? And so let's just say that we start with $0, because that's easy to do. We put in $100 a month, and we do this for 30 years. I'm just going to make it easy, okay? Now, the first one, we had a interest rate after the expenses of 12.14. Now, let me be clear here. In no way do I think that we're going to hold a 12.14 clip in the U.S. stock market for the next 30 years. This is just the data that I'm using, and we're comparing apples to apples 10-year clips of returns, okay? So let me get that clear. So 12.14 is the percent return that we got in this fund after the expenses, okay? So we're going to put 12.14 for the interest rate, and we're going to hit calculate. And you are going to see that if you did $100 a month for 30 years at that interest rate, you would end up with about $300,000. Now, prepare to have a giant number when I change the interest rate. The other one had a 15.57 interest rate. It's going to make a big difference, and this is where you're going to see people chase that higher risk because they want higher return because of this reason. So if I go back here and I change this 12.14 to 15.57, you're going to see that 300,000 go to 584. So pretty much double, just about. So again, you took a little more risk and you almost doubled your investment. Will that always be the case? No, that's not how it works. Could be less, could be way more, just depends on how the market does over the course of your investing timeline. But I just want to show you the difference. I hope that makes sense, okay? The other piece that is very, very important to understand, all right? We had back here, we had these different expense ratios. When you are looking and researching different funds, whether it be mutual funds or ETFs or index funds, the expense ratio is crucial. And I just want to show you with one apples to apples comparison here because it's really, really important. So let's just say that we were investing in two funds that were identical, okay? So I'm going to pull out a calculator so that you can actually see the math that I'm going to do. So we are going to assume that both of the funds are going to earn a 10% interest rate per year, okay? If one of the funds has the expense ratio of 0.015, we would subtract 0.015. So we would end up with a return of 9.985. Okay, you with me so far? I'm going to go back to the compound interest calculator. I'm going to change the interest to 9.985, just like we had on the calculator. Okay, and then I'm going to hit calculate. And you are going to see here that we would end up in this scenario with about $200,000. Okay, just keep that number in your head after we make this change, $200,000. Okay, now I'm going to go back. If we invested in two things that were identical, again, another 10% interest rate return, but one had an expense ratio that we just had of 0.015 and the other one had an expense ratio of 0.73, the return now is way different. We had a return of 9.985 because we had such a cheap expense ratio. Now with the same thing, but we had a higher expense ratio, we now only get a 9.27 return. And so instead of having near 200,000, we have 172. Not as dramatic as what we had with the bigger returns overall from the prior, but still important. And the reason I bring this up is because some of you guys have financial advisors, which is fine, but most financial advisors at least charge 1%. And so again, if we go back to my example here, that's like taking a 10% return and knocking it down to 9%. I did that math wrong. That's like taking a 10% return and knocking it down to 9% because of the financial advisor's expense ratio. I'm not saying advisors are bad. I'm just saying that if you are knowledgeable and can do the stuff on your own, it might be something to consider. Okay. The other piece of this, not just the financial advisor side, but if your investments or what you're invested in or what your advisor is having you invested in is really expensive on the expense ratio side, that is hurting your portfolio overall. Same dollars, my dollar, your dollar, could be invested in two different things and get the same return, but you pay more in expenses and I end up with more money. Okay? So just something to be aware of. That was my kind of point number 2. The final point that I want to make in this case study, or just this like teaching lesson overall, is I just pulled up a historical chart of the S&P 500 here. And I just did it for the last 100 years, pretty much from 1925 to 2025. And the thing that I want to show you, right, is you have all these dips and ups and downs and whatever in the market. That's just how our U.S. stock market works. But what has been the pattern? Up and to the right, up and to the right, okay? People across your investing timeline, CNBC, whatever news you're watching, is going to tell you, okay, when we are in these downtrends, which look like little blips on this chart, but they're probably like years. This was 08 right here. That was a pretty significant downturn. COVID is right here. So anyway, these little blips that occur, people are going to say, hey, panic, sell, the world is going to crumble. Panic, sell, the world's going, especially here, this was a really bad turn. No one can time the market. Okay, no one does it successfully multiple times. I did a video on this. Broken clocks are right twice a day. Okay, you need to, in your investing career, all right, you probably get, if you start at 18 and you die, I don't know, at 80, you get like a 60-year investment timeline. So let's just take a 60-year investment timeline. Right now it's 2025. Let's just do 2020 to make my math easier. And we'll go back to 1960. This would be your investing timeline, okay? You need to not worry about all the little ups and downs within this timeline. You are investing for the long haul. You will catch all those ups and downs as you continue to invest every single month, every single year, whatever your strategy is. So please just don't listen to news. Don't try to market time. The sooner you do this, the more rich you're going to be. And you only get one shot at this life. And so we don't want to screw that up. Okay? Hopefully, overall, the stuff that we went over today is helpful. I kind of wanted to hit multiple points. One of being the risk that you're taking with your investments. A second one being the expense ratios or advisor fees that you are paying if you are paying them. And then the third being potential market timing that people are telling you they can do when they can't. Okay, so that is today's video, and hopefully it's helpful for you because that's the goal of what we're trying to do on this channel.